Hey everyone, welcome to Make Money Count. Today we're going to be talking about CPI numbers, not looking so hot. I mean, looking hot, not looking good.
Yeah.
You know what I mean? It's like,
Oh, man.
it's brutal.
Woo.
Yeah.
We got a problem.
It's hot outside and it's hot in
Okay,
the
so
inflation.
let's start off with what people want to hear. The chance of a July 30th rate hike.
Rate cut.
The chance of a rate hike and the chance of a rate cut are about the same.
Also zero. Yeah.
Zero. Like the actual probability in the market is like 2.75%.
Right.
So,
about the same percentage of the possibility of Trump not being on Epstein's island.
yeah, I mean, for sure he's on Epstein.
Maybe we cut that.
Yeah.
I don't know.
Yeah, no, that's fine. Listen, so because of inflation, and it seems as though the Canadian consumer is starting to get more informed about more nuanced economic frameworks. And I'll tell you what I mean now when I go through this. But we are two idiot mortgage brokers that have a podcast. And for 2 years, we've been talking about the differences between core CPI and top line CPI. That is a nuanced economic term. And we're going to explain why those different readings are the reason for the Bank of Canada's pause on July 30th.
Right.
So first off, I'm sorry that core inflation is running too hot, partly because of tariffs. Groceries, again, like a culprit in there. Thanks, grocery oligopoly. But Globe and Mail article kind of just, you can see it here. The doors firmly slammed shut on a BOC rate cut. The party is over. And then every economist gives their prediction as to what's going on. For sure, we're going to see some cuts in 2025. But again, dependent on this tariff uncertainty. And the tariff uncertainty, unfortunately, is giving a reason to the grocery oligopoly to hike our grocery prices.
Charge more.
And I mean, obviously cars are going up. There's items in there in that core CPI that are going up. Why don't we look at it? So if you have a look here, this is showing you the all items increase. It came in at 1.9. The expectation was that overall CPI number was going to come in at 2%. So 0.1 for the win, 10 basis point for the win. Thank God. It's the core CPI number that's really worrying, which is when you strip out the kind of more volatile and readings. And there's two different core measures, but essentially you're just taking out the things that move around too much, focusing on the things that don't move so much, so you can isolate for like specific economic or weather patterns that have impacted it and get a real feeling for the average as it moves through.
Right.
But again, like if you look at this, food prices increased by like 3%, shelter increasing, households, operations, furnishings, equipment up, transportation was down, clothing and footwear skyrocketed. That's probably big time tariff related. Health and personal care, tariff related. We're going to have a pharmaceutical issue because Canada's not going to be able to export anything to the United States. We're going to have tariffs there, like another problem. Alcoholic beverages, just kind of tobacco, recreational cannabis, hovering around that 2% marker.
Yeah.
Again, just an overall disappointing reading on the core number. Just to highlight,
it's depressing.
Highlight the difference in the core and the top line. So let's take a close look at that. If we can zoom that in. You can see the green line shows from January 2020 to now what has happened with our overall CPI. And that number was like almost 8.25 at its peak mid 2022, and we saw it get down really, really low in 2020. And now, obviously we're below 2%, just below the 2% mark, which is where we want to be. But the trim and median numbers, which are the core number of inflation that
The important ones.
the Bank of Canada is looking for, and what underlines what's actually kind of going on with the economy and the trend of what's happening. You can see, we're obviously off the peak, but we are, if you zoom in on that a little bit, you can see we're kind of heating up a little bit.
Yeah, it's kind of like,
And that no one likes that. And
No.
it's tariff related, it's pesky. Again, I think that it is going to fizzle out because of how poorly our economy is doing.
right.
So you can have tariff related inflation, but inflation is going to be really difficult to get sticky with unemployment.
Right.
So listen, it sucks. I don't like talking about it, but it's there and it's going to delay rate cuts. To be honest, I don't even think a rate cut would do anything right now.
Yeah, it would. Yeah, it would. Exactly.
25 basis points isn't going to bring buyers to the market.
Drop in the bucket, as they say.
It's not going to firm prices up. So, it'll help the consumer, but I don't think it does a ton. And one final chart, RBC had a really good one in their report that they just issued. And I like this one. It just shows you how many, or like what percentage of the basket of the CPI goods are tracking above 3% and above 5% as a growth rate.
Interesting.
So the number of items that are increasing in price by 5% on this 3-month annualized growth rate, it's getting uncomfortable, right? You got 35% above 5%, 56% above 3%. So a good chunk of our basket is experiencing inflation.
A higher inflation. Yeah, yeah.
The problem, when you have no growth and you have inflation, what is it called?
Stagflation.
Yeah, man.
Hey!
That's our problem. So if this continues, we have growth, but we have very, very, very slow growth.
Right.
And we are continuing to slow that growth.
Right.
So we are heading into, unless something happens here, we're heading into stagflation, which is going to be no good for nobody, baby.
Higher interest rates?
I don't think we're going to see higher interest rates.
Right.
I think it's just going to delay when we're going to see lower interest rates.
Right. Right. Can't rise interest rates.
Anyways, on that note, get out there, enjoy the beautiful weather, and we'll see you soon.